And let's look at the losing positions that we should also never add to a losing position. What that does mean, it doesn't mean that you shouldn't double it like the profitable one. You know, when you're profitable, you can always add another one because you're in the right direction, but never double it. Just go half of it every time. Here, when you have a losing position, adding to a losing position by averaging is very dangerous, ladies and gentlemen. Remember, you are investing with a particular margin, and the positions that you are trading are not particularly yours, so you're speculating with it. You merely pay a percentage of the total value. Let's say you're trading with $1,000 and your leverage is 1-to-1. Okay, you're trading with your full 1,000. But if it's 1-to-100, then you're trading with additional 100,000, which the company is giving you, and the liquidity from the bank. So you see, averaging a losing position is equivalent to not admitting your mistakes, which is wrong. One of our first rules: cut your losses short. That you were wrong in the first place is the thing that you always have to admit in order to close a position earlier before wiping your account. Number 7 in our list today is that you should never risk your entire capital on one trade, not even if you're 99.9% sure that the direction will be the one that you see. You should always divide your capital into, let's say, 10 equal parts, and never lose more than 10% on one trade. Of course, this is amendable, those 10% that I mentioned. You should always be able to divide it on 20, which means 5%, or even larger percent, depending on your risk management system or the trading system that you're using. So all of this is amendable depending on the risk management strategy and the trading strategy that you use. 10% is just an example. This is by far the highest level of risk that you can actually get from a professional standpoint. So if you lost the first trade, you still have 9 more opportunities to be right. Let's put it this way. So putting all your capital on one trade is just suicidal. You will wipe out your account because you have 1, maximum 2 opportunities because it's 50-50. But when it's 90-10, that means you have more opportunities to be right. And I'm not saying right because you have to guess that market, but because people make mistakes, and when you admit it, the next time when you're right, you will know what to do. Another rule which is extremely valuable and very important to remember is never to meet your margin call. Do not go into margin call. A spike can kill you. When you're wrong about the market, just get out. Just admit it. Once you start, let's say, prolonging this trade, prolonging these losses, very often prices will go against your position furthermore, triggering margin call from the broker, from the firm, because we cannot allow you to lose more than you actually invested. This is obvious. Otherwise, we have to give it back to the bank, which is not a win-win situation. So just cut your losses and get out of the market. Wait for another opportunity. And what happened here, just an example here, if you will, take a look at the chart, okay? On this chart, I've entered here somewhere around 11:32.99, something like that, when the candlestick opened just below this support and resistance levels here, as you can see. The price briefly spiked up to 36. I waited just about enough to break even, and I got out of the market, even if I knew that the price will continue down. And that would actually going to make me about $500 per lot, and simply I'm trading much heavier than that. So imagine 10 lots is 5,000, 100 lots is 50,000. So you see, it depends on the funds that you have in the account. However, I didn't get panicked. I just knew that the volatility is rising every minute. As close as we're getting to the news, the volatility will rise. As you can see, we have our relative strength index down at the bottom, which means a correction is at hand. Our average directional movement index is starting to pick up, so the volatility is getting stronger. The trend will be much stronger. We have our stochastic down there, so that means we can expect large moves very shortly. Another thing, what we always have to remember, ladies and gentlemen, is to there is a saying there is a recommendation that I can give. Probably not more than 1% of traders have a rule to take profits out of their trading accounts, or basically to withdraw your profits. The few traders out there that I've seen have actually taken this as a consideration first. Second, to do it is another thing. I know that this is a very simple step. Basically, you can just leave your profits there, trade with everything you have, to increase your percentage on a risk, of course. But for those that are not experienced to sustain today's market turmoil, withdrawing at least 1% of your profits every time, like let's say every month, every third month, or every 6 months, or every year, depending on the way that you're trading, is always safe, because you can protect yourself from future surprises, something that you might not be prepared for. And this is valid for those that are, let's say, just putting up the shoes of trading, stepping into the market for the first time, or have been in let's say in the bad side of the trade. So taking a certain percent out of your profits into your bank account is a safe way to ensure that a percentage of these profits will stay safe no matter what happens. This is for you to decide. That's why it's just a minor rule. However, it's never to be underestimated, especially for those that are here for the first time. Another thing, the last golden rule that we need to have is to always have a trading plan. The lack of a trading plan is like not knowing what to do when you're wrong, and not knowing what to do even when you're right. So you see, to have a game plan or a trading plan is always important, and it's an integral part for everyone experience on the market. Now let's have a look briefly here for today's calendar. I'm not going to switch through it, so let's keep looking at that chart first. Second, what we're expecting today in about 11 minutes. This is the durable goods orders for US, also followed by a speech by Fed's William Dudley. Of course, a speech that should never be underestimated. Some media are actually going to broadcast this live, or you might be able to find comments on the web of what Mr. Dudley, actually said. And this will be with correspondence to the Federal Reserve rate hike. Of course, we are also looking to see the crude oil stock change from the Energy Information Administration later on. Today it's at 3 p.m. GMT. Before that, we need to focus on that durable goods report. Now, the forecast is for -0.4%. The previous month, now this is coming out for the month of July, that means for the month of June, we had 3.4% growth in durable goods. So that means if we see a number below 3.4% or even negative to minus something like minus 0.4% or minus 0.1%, doesn't matter how low it would be than the previous one, it's still negative for the US economy. We can see that the gold might start picking up. It's an inflationary indicator. And that's why I've picked up this chart and this particular instrument that I've been trading since the morning. Actually, since yesterday, to be honest with you, we've had numerous of signals from here. Also, you can see that this is the strategy that I'm currently using. It's quite valuable. So if you just have pen and paper or just make a screenshot for future references to use this particular strategy, we actually covered it many times in our advanced strategies before. So you can see this is pretty much a drop with about $14 until today. From yesterday, we can see that it's about $22, even $23 drop in gold price. So simply put, when we got that signal out from here, our indicators were actually more neutral rather than actually bearish. Even if the trend has started to establish here on the MACD, we didn't get that signal until yesterday from the ADX here. As you can see, it broke off in a negative territory, so we could have sold that, and that was one of our first targets. Of course, this is the more complex strategy that I'm using. So I have to remind to those that are using our signals that this particular strategy does not fit into the signals that we're sending. We're using a much more simple one, which averages about 80 to 80% certainty. So this is pretty much to secure our funds, to be absolutely sure that everything will be in the right direction, to rarely hit the stop loss. Therefore, this particular riskier strategy is one that I'm using on my daily trading. And if you're seeing it fit into your particular trading plan, you can use that as well. So today I will give you my preparation, my trading plan, the way that I prepare myself to trade, the way that I behave while trading, and what I do after. That's why this brings us to the last webinar we had last week. This is our structure of the trading plan. Still, I'm not going to show it to you. We already know how it goes. We know the structure. So for those that have been there, they probably already took it out on a piece of paper and they're looking at it. That's why we just need that chart to see what our entries are, also to look at the economic calendar. As we just mentioned, that we're expecting the durable goods orders. That means an inflationary indicator is always impacting the dollar. And speaking of inflation, that will definitely hit the gold price, as well as we know interest rate hike always returns in a negative effect over gold, because it becomes much more expensive for holders with other currencies. That means, you know, as you can see, I've been bearish second day for gold. It's been a lot of profit so far, not even one losable trade, according to the strategy that you see in front of you, and that's not the first time you actually see it. But the pre-trade, the way that we are preparing ourselves for the market, is the most important thing. So let's forget about that we've been on the market for many years. Let's say we are basic traders. This is the moment that we're actually, okay, let's say yesterday at the evening, you've opened a live account, you funded your account, everything is ready for you to trade. So you're waiting for the next trading day to open, so you can have liquidity, you can have volatility, and you can trade, basically. What should you do? The first thing you have to see is what happened yesterday. Okay, today, this morning, you're waking up. So what happened yesterday? We had sell-off on the euro. We had a downside on gold. We had further a downside on the Japanese yen, for example. And let's stop until this. So what is actually causing that? What we saw is slight improvement of the US economy that is always boosting the dollar. In correlation to that, the currencies that we're trading against are going to decrease in value. So what does that means that today's trend is much more likely to continue instead of reverse, one of the basic rules of Dow Jones. Now, what we have today is durable goods orders, high volatility expectations on any economic calendar. Let's have a look at it. There we go. The economic calendar. Have durable goods orders excluding transportation and durable goods orders in total. Now, all of these numbers are extremely important. The one that is more important is, in fact, the total durable goods orders. In percentages is what it's measured, minus 0.4%, as we mentioned earlier, 3.4% previous month of June. So whatever number comes today, it should be always above 3.4%. To make any sense for the Federal Reserve to actually hike any interest rates in September, which is very close to impossible at this stage, given the fact China's economy, oil prices went to hell. Also, tomorrow we're looking at the data that I mentioned, continuing in initial jobless claims, gross domestic product, personal consumption expenditures, and many more. Price, pending home sales, so on and so forth. All of this is inflation indicators, and of course, gross domestic product will actually show us how the economy has been behaving for the past 3 months, and of course, for the past 1 year, which is the gross domestic product annualized. Now, all of this probably is well known to many traders that are at the webinar this moment. Still, I need to mention it for those that are here for the first time, because it is much more difficult for those that are here for the first time, that today is their first trading day and they're stepping into a large volatility market. So what to do? Now, we know what to expect on the market. High volatility on gold, euro dollar, GBP USD, USD JPY, so on and so forth. Any other currency that is crossed with the dollar or connected to the dollar is a major. That means two things. We either going to trade on the news, or we're either going to trade technically out of the news. What does that mean? If we are going to trade along the news, we need to stay dormant until the numbers are out. If they're good for the US economy, it's always bad for gold, at least at today's market. If it's bad for the dollar, it's good for gold. You see, it's not so difficult to understand. So if you see green numbers here, that means gold is going down. If we see red numbers here, gold will go up. And it's the same on Thursday. All of these numbers here that you can see. As we can see, the expectations are steady for increase, steady for decline with jobless claims, so on and so forth. So we can actually expect gold price to decline until the actual numbers are there. That brings us to our charts. Sorry, I just hit it. That brings us directly to our charts. There it is, gold chart. Switching to 4-hour chart, you can see it's still not confirmed to the downside. So there's a lot of uncertainty in the mid-term. That's why we're trading small. 1 hour, 30-minute chart, you can see how many opportunities we had here since yesterday. From here, that was yesterday. from today, further downside. So you see, according to our strategy, gold is declining steadily within a trend, short-term trend, which we are following. So we know that news are coming up. We don't trade at least 1 hour prior to those news, and depending on the news, we don't trade at least 4 hours after the trade, after the news. This is from technical standpoint. So if you want to stay on the safe side and you are only technical trader, stay away from the news. And if you are a fundamental trader, use the system accordingly that we showed you before. 2 types of systems, even if I recall, maybe 3 different types of news trading strategies. One that it's connected to market pricing from technical standpoint, and one which is only data dependent. So depending on the way the trader that you are, assess the market accordingly, and if you cannot do that alone, we're always here to help. Now, I had an open position since here, but I had to close it because the market reversed more than 30% for me, so I had to take that profit. And I'm still waiting for the news to come out just to see what the news are. Let's actually check that out. It's probably already there. Yep, we have our durable goods orders 2% higher, 0.6% on excluding transportation. So it's above. Let me show it to you. Sorry, I got it a little bit excited here. So we have durable goods orders that are 2% from 0.4% revised. However, this is still negative from previous numbers. Also, we have durable goods orders excluding transportation, 0.6% higher than 0.4% forecasted, but still lower than 1% previous. So what we can expect is short-term price movement to the downside of gold, and then we can see price stabilization, and then price will pick up. However, with expectations of tomorrow, the gross domestic product and the rest of the data, we can still see a lot of uncertainty. So it doesn't matter that the numbers are green here. It's still bad because we can see that here we have higher numbers on the previous month. And we can see that gold price is actually struggling right now to find its way. Switching back to our chart, let's have a look at it one more time. There we go. Gold chart struggling at the moment to find its direction. As I mentioned, it will be a brief slide of these prices according to the news. However, right now is a lot of uncertainty depending on tomorrow's data. So if we are fundamental traders and we're trading on 30-minute chart and lower charts, that means we're selling gold right now for a fast target of about $3 to $5 in direction. After that, we're closing our positions and waiting for the next data tomorrow. There we go. I just scalped this one. It's about $1,700 I just made on this $1 drop within the price. So this was just while I'm talking to you. But that's about it. That's about the profit that I want to make. Now, why is that? Let's have a look at the 4-hour chart. We're at the support level of the 200 exponential moving average. So further downside will continue when we have a confirmation on this technical level. And we still don't have a direction from our ADX. However, the trends are starting to pick up. The volatility is still lower. We can see that it's the strength of that trend is declining. But as we know, the ADX line is a little bit of a slowing indicator. So until the price starts getting steadier and we can see a steady lift up above the level of 20 of the ADX, then we can see the actual technical trading. Right now is more of a fundamental part, orders executing and then closed really fast, or profits that are taking from institutions or hedge funds or any other traders that had positions to the downside or to the upside, and stops are actually hidden. So you see, we are at the support level at this stage. This 61.8% on this Fibonacci is on our current downtrend. So you know, after this trend reversed to the side, to the sideways, this 1127 level has become our turning point. Closing below this level, especially on daily chart, you can see that our moving average is here. There's a lot of support levels standing there. Given the fact that gold closes below this level here, we can expect to come down to 1100. That's about $20 to the downside again, even more than $20. So it all depends on the strategy that you're using, how risky trader you are, and what you do meanwhile during your trades. So trading on the news, you know, scalping the market needs a very strict state of mind. So you have to be stone cold. If you're losing any kind of position, just close it when you see that it's going bad. If you have a winning position, just let it run for a couple of minutes, and then just take your profit and wait for another opportunity. And here you can see that move on the 5-minute chart. Just after this release, we had the reverse of this direction after those parabolics occurred up there. This is pretty much here where I opened my position. This is where I closed at about $1.50, which is absolutely enough for this movement. Now I'm going to stay away from the market until the majority of traders actually digest the information for this commodity to find its direction. So right now is the most riskier part of the market. It's going to be choppy trade until the market finds a direction, and then we can all start trading. And given the fact that we're about 52 minutes prior US market open, so basically during that time the market is extremely dangerous and very uncertain. So what I do is just watch the behavior of the majority of traders, what they do, where they're pushing the price. And even if it goes down to 1117 or even 1115, you will see how fast the price will actually return to its general levels around 1120, 26, 27, where is actually the level from technical standpoint that needs to be broken so we can see further downside. And this is something that you can enjoy and monitor on your own. You can trade it if you wish. But let's say right now we've exited the market. We had our final trade for today. Actually, I had 3 more trades before this one, so this is the 4th one. So far, not even one losable position today. According to the strategy, as I mentioned, it's limiting the risk quite good. What we do right now is to be always calm and stay on the safe side. Do not risk your profits. You've already done very good. So what I do is just enjoy the news, see how the market will react. What are the comments, for instance, in the news agencies? Just read about it. Assess carefully the information that I just got. And then, after a couple hours, let's say when the European market closes around in about, this is 2 hours and 20 minutes time from now, let's say the market will be closed. Then the only market that will be left is the US market. From then we can expect some very strong trend to pick up, to take direction. So prior to tomorrow's news, we have a lot of uncertainty. Tomorrow is basically the most important day of this week, and depending on the data that we'll receive tomorrow, we'll actually see how the Federal Reserve will react. The second week of September, I'm not going to switch through the calendar. I will prepare that for you on Friday, when we will have the last session for the series. Until then, I would beg you for questions. Also, if you have any particular interest in this strategy, I will also be happy to receive questions. Simply, this is the improved version of our last strategy that we used, which is called Find the Right Direction. In combination of various indicators, we have very clean signals, very accurate signals with very few mistakes. But of course, you always have to have the gut feeling when the strategy fails, especially around particular news like these. You know, it can always fail. So that's why I'm staying away from the market, just to see how other traders will react. It is very important for us to carefully assess everything that is being given to us just about now. And this is what I will do until the end of today, because tomorrow is another day. I already reached more than half of my, 1.5% higher than the target that I actually set on today for myself, though. Post-trade is what we do when we shut down our terminal, our trading platform, our computer. This is what we do, for example, when we gather up with our fellow traders. Let's say you've got someone else that you know personally, he's a trusted friend, or just a buddy that you know, that you can actually discuss the market. You invite them over a beer at the bar, sit down, discuss the market, see what's his opinion on the matter, what he thinks about it. You see, it's always good to discuss the market with someone. It doesn't matter if he knows more or less than you do, but it's always good to discuss it, simply because when you say the things out loud, they make much more sense than they actually do when you think it over in your head. It's very simple, because you don't really hear yourself. You see, when you think, you only think that you hear yourself, but you hear your thoughts. You don't hear your voice, how you sound, how much sense you're actually making. And furthermore, it's always good to hear somebody else's opinion. Doesn't matter if it corresponds with yours or it's completely different. It's always good to look at another perspective. Somebody else's opinion is always a good trainer on a post-trade situation. And this is pretty much what I do with my colleagues. After we finish the trading day, we discuss the market, we exchange the experience we had today, on the particular trading day. We gather more information by exchanging our knowledge we gained on this trading day. This is how you will get much more excited by gathering more information, be much more confident when you have to make a decision tomorrow. And of course, when you wake up, you are starting the day by the same way, informing yourself what happened during the time that you've been out of the market, because there are other markets that are moving the prices. And you need to know what they've been up to and how is that going to affect the new day that you are going to be involved in. So that's about it. Nothing complicated, as you can see. It's always one and the same thing that I've kept reminding each and one of you guys when we've been on one-on-one sessions, of course, depending on the level that you're in. some of the things that we discuss are a bit more simple, some are more complex. But still, at the end of the day, what we need to accomplish is our goal that we set from the beginning, from the pre-trade. Another example, and that will be the last one, when I took upon the market today, I woke up on this candlestick. It was just developing. Okay, it was just developing. That was quite early. That was during the Asian session here. This candlestick. Then I was fully awake. Let's put it this way, because don't get me wrong, I'm not a market junkie. I just wake up sometimes just to see what the market is up to. It keeps me focused for the next day. So I woke up on this doji here, on this choppy trading session. Let me zoom it in, those that don't see it well. This particular candlestick developed during my pre-trade. I was getting informed to see what the market is up to. So my decision was to start selling somewhere around these levels here. Okay, this is well below the previous day. A good support level, which if broken, we can expect a more downside. Also, those $3 of trade that I missed, I was not really regretting for this, but simply setting my pending order somewhere below the 1135, 1134 for targets around 1127. Still, I was taking my profits gradually every time, because just before we actually ended up in a session of this webinar, I achieved my full target, very close to this 200 exponential moving average. And of course, as you can see, around this level is a lot of support here, so I didn't want to risk too much. And of course, according to the news, I just scalped the market for a fast profit, which makes it the end of my trading day. And tomorrow, it is quite obvious that we might have been able to expect the same direction. If these levels are confirmed, we can expect a crossover with the next couple of hours when this candlestick closes. But before that, we might be able to see some ease of the volatility, from where we can consider better options, like entering close to 1132, maybe 33, 34. This would be a good level, a bounce off from this particular moving average. If you just make some kind of, a projection here, you can see that it's about this level here high. Still, I would prefer, from a safe side, if I'm sending a signal to someone, to see the price closing down here for a trade to these levels down here. That's about $19 to $20 price target. Pretty good, I would say, for Friday, for Thursday and Friday. Of course, all of this is data dependent. So whatever positions we have during the European session, prior to those news, we would stay away, just to ensure that our profits that we've made are secured, are actually profits and not running profits. So that's the last for today's session. Thank you very much, guys, for joining us. And we have a brief. Okay, yeah, I can see there is a particular question here on for a different commodity. Our trader here, as well as usual, Luke is always active with questions, always on target with the session. So, all right, Luke, I will very much glad to indulge your question. And first of all, let me read it out loud. Can you have a look at crude oil on the 4-hour chart? It seems a big bullish trend could be coming. Well, without even looking at the chart, Luke, of course I will do that. What I actually mentioned 2 days ago to one of my colleagues. He was like, "Oh man, gold, oil went down with another $2-3. What's happening?" Well, it really depends on today's news, Luke, especially when we're expecting the Energy Information Administration to give us some more details on the stockpiles. This would be able to set the direction for, let me just put in this template that I've just used. Okay, this is the 4-hour chart. First of all, this could be just a false breakout. To have a bullish trend, we at least need to see that MACD above the zero line. So that could take some time. Given the fact that we have a lot of production from the OPEC countries, also from the Gulf of Mexico, the crude oil. So it doesn't matter if you're trading Brent or crude oil. It is pretty much the same direction with two different benchmarks. So it's one of the same oil, one of it's heavier, the other one is lighter, but it's still one of the same product. Still, the lighter one is cheaper than the other one, but it's one and the same. And it's the same with gold. You see, you have only one metal that has the same physical qualities like gold. So what we need to see is higher demand, and with the Chinese economy, that it's one of the major importers of oil, I don't believe that's possible to see in the near future. What we see is just a retracement look on the recent downside. Now I'm going to show you why. Okay, take a look at that monthly chart. You see how the price is acting. It's a lot of support here. My support levels were around the $40 a barrel, where I actually stopped trading oil because it already reached high levels here, you see. So this is just a pullback from the current trend. We're up to see some all-time lows on oil prices, so it's very dangerous even for me to trade that particular commodity. Still, I just want to see on a weekly basis what the Energy Information Administration will say, what kind of data, what is the projection for crude oil stock change. It's important because we're not focusing on months and months of trading, on contracts that are being rolled over. We would like to close our positions and end our contracts within the borders of 1 month. So what we're interested in is just one particular candlestick. And when I stopped trading, it was around the $40 a barrel, where the major support of these closings of these candlesticks here occurred. You see the closing is at 41.60, where I ended the signals for the crude oil. So a major trend, when you speak of a major trend, major trends are visible on daily and weekly charts. And as we can see, a major trend on uptrend on oil is highly unlikely. What we can see is short to mid-term trends to the upside, but not even close to a long-term trend. It's not going to be any near to 2017 by my count to reestablish this oil consumption that we had 2-3 years ago, when the prices were like $150 a barrel and 114 for crude oil. So that was amazing. I mean, prices are like 3 times lower now. And looking at 4-hour chart time frame, we can only look for midterm trends. And given the fact that this particular levels here, the 14 that I've set, is a much smoothened out on the 4 and daily chart, where I can enter the market. In any breakouts above it, I'm always staying away from the market just to see what it's going to do for further for future references. But to see some further moves to the upside, we need at least $50 a barrel sustained trading to see some a long-term uptrend, which in near term is close to impossible. And just look at the 200 exponential. It's so much 45 degrees than anything else. So 45 degrees trend is just beautiful. What I expect is to see a sideways. Sideways for me is sounds much better than any kind of trend. We see major support, the lack of consumption on this commodity in the energy sector, mostly in the winter season as we're approaching in the northern hemisphere. We can see more consumption of natural gas, you see. The natural gas is, especially in UK or any other countries where this is like accustomed to use it for heating or for cooking, you know, any kind of home duties, if you want to put it this way. So I would bet on, you know, on natural gas until the end of December, January. That would be a good place to trade within the energy sector. However, I'm not a big fan of trading gas, you know, natural gas. I always stick to crude oil and gold, some of the majors as well, basically because my specialty is oil and gold trading. But major uptrend on oil is highly unlikely, even though you see it on the 4-hour chart. But short to mid-term trend to the upside, I would much more agree rather than long term. So I hope I answered your question, which pushes us very close to our boundaries of today's session. So whatever questions you might have in, you know, furthermore about this thematics, please direct your questions to my email or to your account manager so we can continue this conversation over the phone or within an email. And thank you very much for your relevant question, Luke, as usual. And for all of other questions which will be answered shortly. So thank you very much for joining us. Please be welcome. On Friday is our last session for this 2 months. We will have a look at another case of this particular plan. We will plan one more time so we can just make a concrete base for our future trading experience. Thank you very much for joining us. I'll see you next time. Bye-bye.